Can the ECB save the euro, or is the tumble going to continue? No matter what they do, hike rates, cut rates. That's what we're going to be talking about today. Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And after a US CPI report that was incredibly just narrowly in line with expectations enough that it did not cause a stir in markets and allowed people to go about their business undisturbed, we have another bit of fundamental event risk here, this time from across the Atlantic. The ECB makes its policy announcement today, and the euro has some interesting price action going in that maybe hints that it's not so much within the power of the ECB to really revive its fortunes. But let's take a look and see what the moving parts are here and consider what may be the way forward. We'll start with, first of all, where we are expected to actually be on this policy announcement, what's expected to happen, where our rates seem going, and then see why that may or may not be what actually occurs. So first and foremost, here are the going expectations. So there's about a 65% chance that the ECB is going to hike rates by another 25 basis points at this policy announcement. You can see that in the first line of the September 14th column there. Hikes, cuts, the first number there, 64.6% or almost 65% chance that we're going to get a hike. We can see in the implied rate delta column, 16 basis points of a 25 basis point move have been baked in. So not surprisingly, just a little over half. And so here we are at a likelihood that's a little bit over half as well. We can see that one full rate hike is fully priced in at this point through December. So at one of these three meetings, either this one or October or December, the markets now think we are going to get a hike. So you can see here the implied rate delta for that column, 0.26. So that's one full 25 basis point rate hike all the way baked in. Now, this is actually a meaningfully hawkish shift in expectations. When we were looking at this even just 48 hours ago, even 24 hours ago, this looked like about a 75% chance that we're going to get a rate hike at some point this year. So that we've moved into certainty mode, even if we're not sure which meeting it's going to happen at, that's a potent hawkish shift. So we can see the likeliest outcome still that we're going to get it at this September meeting. There's then about an 18% chance that we're going to get it in October and about a 23% chance that we're going to get it in December if it doesn't occur here or here. So with that in mind, what's going on here and why are the shifts occurring? Well, there may have been a leak out of the ECB here. The news comes from Reuters. They report from an unnamed source that is nevertheless apparently informed in an intimate way and has direct knowledge of what this is. The ECB is going to upgrade its inflation forecast up to 3% for next year, while cutting growth expectations for this year and next year. The assumption being that we'll need higher rates to combat this higher inflation, and the cost of that or growth, and we're putting it in our forecast, which is to say, we recognize that we're taking the economy in this direction, and it's what we intend to do, so we're going to. Now, you can see that here. So while there's been a shift in ECB policy expectations in a more dovish direction relative to when the central bank last met at the end of July, so you can see where that yield curve was when they met. That's the big dashed line there. The current line is the solid one, which you can see is a little bit higher in turn versus last week, the little dashed line, because we've had this hawkish shift nearer term. So we're still looking at an ECB that's expected to be more dovish than they were at the end of July, but less so than last week. Now, the really interesting bit here is the euro did not seem to care very much at all that a rate hike has gone from a 75% probability cumulatively to a 100% likelihood. That didn't seem to matter. The euro popped a little bit toward the top of its range, as you can see here. This is the 6E futures contract, the current active one. You see here, there's a pop, and then we come right back and remain well within the bounds of the range that we've been in really since the end of last week. And so the euro's response to this ostensibly hawkish shift in expectations has been, yeah, I don't care. Which, on the face of things, speaks to a significant underlying weakness. If any asset is unable to rally or find some degree of strength in textbook supportive economic developments and policy developments, well, then the market clearly has an inherently bearish view of that asset and just refuses to buy even when the news is good. That typically speaks to significant underlying weakness. And by the way, it works the same way. If an asset is not responding to bad news, that probably means it has significant underlying strength for the same reasons, the same kind of logic. So the euro doesn't respond here as if to say, yeah, okay, rate hike. That still doesn't make the euro any stronger or any more appealing. So why is that? Well, the ECB faces quite the rock and a hard place kind of challenge here. And perhaps what this response speaks to is the direction in which they might hope to resolve it. On the one hand, inflation expectations are still going up. And that's, of course, anathema for the ECB. They very much would like for them to not be doing that because they've clearly had this big rate hike cycle. Inflation has come down helpfully from over 10% down to 5.3. But as we can see here, inflation expectations, both from the bond market there with the German 10-year break-even and the swaps market with the Euro 5-year swap, both of those seem to suggest that the way forward is going to be more challenging. We can see that they lead CPI with about a 6-month lag. So CPI seems to make major turning points with about a 6-month disconnect from these forward-looking expectations. And they're not just not falling, they're pointing the wrong way. They're actually trending higher, implying that the ECB is going to have a hard go of continuing to push inflation lower if we remain on current trajectory. Now, seemingly this calls for rate hikes. But it's not that simple. Because at the same time that this is occurring, the Eurozone economy is also ostensibly flirting with recession, if not already in one. What we see here is the composite PMI number, which is a kind of catch-all of manufacturing and services PMI numbers, and the three of them together a kind of catch-all for what the general tenor of news flow out of the Eurozone has been, which is to say, soft and disappointing. That's showing us that the economy has now contracted for 2 consecutive months, August and July. You see that in seeing the blue line there under 50. 50 in the logic of PMIs is a kind of boom-bust divider, where above 50 is growth, below 50 is contraction. If you get further above 50, that's growth accelerating. If you get further below 50, that's contraction accelerating. So what we see in the way the blue line has behaved recently is over the past 2 months, first, we're below 50, so the economy is contracting. Activity in the manufacturing and services sectors taken together is contracting. Secondly, it is contracting at an accelerating speed. So if we're not in a recession, we're certainly looking like one is coming any day now. Germany's economy already shrank in the second quarter. If this represents a spreading of the malaise, now region-wide and running for 2 consecutive months in a row, it's probably the case that the qualifying condition of 2 consecutive quarters of negative growth is not too far off. That, of course, beckons rate cuts, not hikes. And so the ECB finds itself in this sort of stagflation policy challenge, where the expectations seem to demand that they do more. The markets seem to think that they don't have this inflation thing in hand. Meanwhile, growth is coming undone, and the impetus isn't to tighten the screws further. It's to find a reason to let them loose a bit. So, how does the ECB reconcile this? Well, the makeup of what is sticky Eurozone inflation at this point can be the critical consideration. We can see that the bulk of the disinflation that we've been watching so far has occurred in that light gray area that you see on the screen there: housing, water, electricity, and gas. And most of that has been the gas thing, because natural gas has been in free fall since peaking shortly after Russia's initial invasion of Ukraine, which raised these concerns about maybe supply disruption. That has not actually materialized. In fact, Russia seems absolutely intent on flooding the market with cheap natural gas, and inventories in Europe are almost completely full. So we're looking at a situation where there was a surge in the price of gas. It then collapsed back inward, and that's been the way that we've generally come down from inflation north of 10% to inflation now at 5.3. So that's this gray area, as you can see here. It's very wide. It's a very big contribution here, and now it's gotten so narrow that on this latest bar here, it's just another little bit. That, of course, leaves this food inflation as the main culprit that's keeping things sticky. Now, this is where the ECB's sort of tactical risk-reward thinking is perhaps activated. It's obviously nothing that the ECB is going to do with interest rates to discourage people from eating. So what is there to be done about food inflation that's sticky and that seems to be undermining the ECB's attempts to get where it needs to go? There's arguably not a whole lot that the ECB has agency over. But there is some indication that there could be a bit of a respite. If we look at where those food prices might be coming from. The temptation, of course, is to again point the finger at the war in Ukraine and say, well, the world's number 1 and number 5 wheat exporters are fighting. Is it any wonder that food is more expensive? Well, it's not in the grain space, as it turns out, that this issue is occurring. We can see that with the yellow line there. That's the Bloomberg Commodity Index grains subcomponent. It has basically stabilized after a period in decline. Again, we had that early spike at the beginning of last year when the war began. And since then, grains have moved mostly lower, albeit in a very moderate way, and now seem to be kind of stabilizing this year at a lower level than the spike. They're generally higher, of course, than they were before the pandemic. There's no question there. But in terms of an outsized influence that on food that has emerged now and perhaps started to drive things as of, so we can see here, mid-2021, that doesn't seem to be where the issue is. Rather, soft commodities, that seems to be where the concern comes. We can see that's been moving higher since about late last year. Much of that may be feeding into food prices and certainly would line up in terms of time with where that boost would come. They're helpfully starting to pull back a little bit, so maybe there is a bit of a relief valve. Much of this, we can see here, seems to come from sugar. So looking at why soft commodities are up, there is generally a kind of mixing of coffee, cotton, and sugar in this mix and sort of dominating the soft commodity benchmarks. And there's not been that great of a performance from either coffee or cotton. It's sugar that's really surged recently, and that seems to be what's echoing here. The concerns there were largely around some trade restrictions on sugar coming out of India. The market is still relatively elevated, but it's now kind of in digestion mode. It still hasn't retaken the March highs. So we might be in a situation now where things are starting to digest, especially since Brazil, which is the world's largest sugar producer, seems to have had a relatively decent crop. So we may be looking at a sugar powered food inflation that's going to give way of its own accord. Now, of course, the other thing that you immediately see when you take a look at this is energy has been a big source of disinflation, and that's very much that natural gas thing that we just saw here, very much that gray area narrowing. That's in large part how energy has been such a disinflationary force. You can see in the red there the energy index. But most recently, it's perked up a little bit. And that isn't because of natural gas. That continues to be downbeat and has been hugging the floor in a tight range basically since April. Rather, the pickup has been about crude oil. That's been up significantly. And that could be something that then feeds into inflation and complicates the ECB's job if it sticks. But it's that if that's really interesting, because the reason the pickup has happened is because OPEC and its allies seem to want to cut output. Saudi Arabia has stepped out and said they're going to extend an output restriction cap that they introduced back in July through the end of the year, whereby they withhold 1 million barrels per day in output. If you think that that's going to continue to drive crude oil prices higher, as the markets seem to have reckoned so far, that could certainly feed into inflation. Whether that's possible depends, but the history would suggest that the odds are not stacked in OPEC's and Saudi Arabia's favor. As we can see here, since the cartel introduced sort of this more active management to the quota, they really have struggled to be at the quota even once. So somewhere in 2014, they initially launched this. We can see we hugged the quota in the very early months of this regime. We have since overproduced consistently. And though the framework here has been successful in holding output below capacity, we can see capacity much higher than what's actually being produced. The average overshoot relative to target has been about 2.5 million barrels a day. This year, it's been even more, about 3 million barrels a day. So if Saudi cuts 1 million, the question is, will somebody make up that shortfall? Well, there's certainly capacity to make it get up. OPEC is producing much less than it ostensibly could. But you might think, why would other producers undermine the efforts that Saudi Arabia is taking? After all, it is the sort of de facto OPEC figurehead. Why would they fight this? Well, the history seems to suggest that if you compare the output direction with the price, it's the output chasing the price, not the other way around. The price management from OPEC here doesn't seem to be counter-cyclical, in other words. It appears to be pro-cyclical. So when you get this start of a decline in prices, A1, you then see production being cut, A2 onward. Now, you might think that this is exactly what's supposed to happen. Prices go down, output is cut, maybe that'll uplift the prices as a countermeasure, but that's not what happens. What you see is the price continues to go down. As it goes down, output is cut more, B1 and B2. But as it starts to rise, output is increased, C1 and C2. Because people ostensibly don't want to be selling oil when it's falling in price, but do want to be selling oil when it's rising, because that makes more money. And so with Saudi cutting 1 million off and OPEC members clearly not feeling too precious about this target, considering they haven't spent much time at target at all and are constantly out producing and still have capacity to outproduce. The sense is, well, if they cut $1 million or 1 million barrels a day, and there is already an overshoot of 2 million barrels a day more, what does that really do? But furthermore, how easy would it be for other producers to step in and recreate that 1 million barrels from another source when rising prices, as they have been now, seem to encourage more production? Well, that seems like a likely scenario that undermines Saudi efforts and does not allow for a meaningful energy shock to inflation. So, looking at what the ECB might be thinking here, the issue seems to be food inflation and not energy. Food inflation might well ease on its own because soft commodities have started to come back in. And the pop in energy probably isn't something that's lasting. So why squeeze an economy already in recession? Why not let that recession work inflation down by the squeeze that it's applying to economic growth? Why not take a step back and say, okay, we think that it's the recession itself that will work demand down. And that will crimp inflation because economic activity will continue to shrink. Demand will continue to shrink. Without demand, there is no pricing power. And so perhaps this thing will resolve itself if this is what the problem is. It's very different, for example, from the US, where the problem is in the service sector and mainly with housing services and labor. It's very different from the UK, where, again, it's in the service sector and the main issue is labor. This is goods-based. And an economic tightening will work against it. So from that perspective, might the ECB say, you know what? We don't need to hike at all at this point. We're just going to wait and see. Now, if OPEC is suddenly successful, we'll have time to respond to that. But at the moment, there doesn't seem to be a lot of very good reasons to squeeze an already very beaten up economy. But of course, we already have a full rate hike priced in at this point. So if the ECB doesn't hike rates and signals it's probably done hiking them not just this month, but in general, in this cycle, well, then there's a bunch of people positioned on the wrong end of the market that are going to have to adjust those exposures. And from the perspective of the euro, that probably means further weakness. So right now we're flirting with support just above or just below rather the 107 figure. Resistance seems to be just below 108. If we can get through that support, there seems to be another swing bottom support around 106.50. Then after that, relatively little but air on the way down to support just above 105, where you had the bottoms for the year. Alternatively, if you make it above that resistance, the one that's under 108, then a test of the 109 figure and that former support turn resistance wedge just underneath that level is probably in the works. But this would imply that the path of least resistance is in fact lower, and that perhaps the euro will find its way toward 106 before 109. And that is macro money for today. We're here every day, Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio, talking about the day's events on Wall Street and in the preceding 24 hours for global markets and what they might mean going forward. I'm also on with Chris for Futures Power Hour on Fridays, on with Tom and Tony for First Call on Sundays, opining on the written portion, the news and insights portion of tastylive.com. In fact, a summary of this very video, this very episode is there currently, if you want to catch up in a hurry. And of course, also sending out sporadic messages on Twitter. Yes, Twitter, at eur-usd. Thanks very much for joining. Macro Money will be back tomorrow. Happy trading. Take care.